We now turn to the arithmetic Brownian motion version of the binomial option valuation model. This is going to follow very closely the way we presented module 5.2, the geometric Brownian motion binomial option valuation model. And so it turns out the arithmetic Brownian motion framework with the binomial results in a terminal normal distribution. And you may recall in studying different distributions that the sum of normally distributed random variables is normally distributed. And so we're going to explore an additive model as opposed to a multiplicative model. We'll again address dividends, digital options, both European style and American style, and generate similar plots like we did in module 5.2. The central finance concepts is this is arithmetic Brownian motion and not geometric. Geometric tends to the log normal distribution in the limit. Arithmetic tends to the normal distribution. And later in a module using continuous compounding, we'll actually contrast these two philosophical frameworks. This will be a binomial option valuation model. We'll illustrate it with the 1 and 2 period models. There'll be a unique set of ABM coherence conditions. Dividends will be addressed. The multi-period model will be addressed, and we'll have some graphical illustrations. The key insight on the ABM binomial framework is that it is additive in nature. We again must have recombining in order to have the tree manageable even with modern computer power. We'll incorporate dividends, both discrete and continuous, and address the early exercise feature of American style options. The binomial lattice, you look at a 1 period model. The beauty of the 1 period model is it's a great heuristic, kind of like a toy car trying to illustrate something. It's intuitive, it's simple. The 2 period model will provide dynamic insights. The multi-period model, however, is the model that can be deployed. The European style is easier to deploy, but it's going to turn out, as best I could figure out, that even European style requires backward recursion for some technical reasons. And perhaps one day maybe I'll find a solution to that problem. American style requires addressing potential early exercise, so we have to use backward recursion there anyway. There'll be coherence conditions in order to converge to the binomial. In order to converge to the log normal distribution, we have to have certain coherence conditions, and so we want to avoid arbitrage within this sterile theoretical environment. It's deeply useful when exploring alternative models to deploy in practice. We don't want to deploy a model that has inherent arbitrage possibilities. Discrete dividends, the ABM approach is very unique in that it can actually it recombines very easily because of the additive nature, and assuming a constant dividend across the tree, the tree does in fact recombine. The continuous dividend is unrealistic with stock options that pay, say, 4 times a year, but perhaps it's more realistic with index options and other instruments. Remember, the escrow method is going to result in bifurcating the stock into 2 components: the stock without the present value of dividends over the option life and the present value of dividends. The multi-period model, again, we have the same problem of the probability of a single path tends to 0 as the number of time steps go up, and the number of potential paths tends to positive infinity. The ABM is going to require backward recursion for both European style and American style, but the backward recursion allows easy treatment of early exercise. So we're going to illustrate several things just like we did before, and there are certain key things that I'm going to focus on, but let's look at some of these sensitivities. So the call price, this is the familiar theoretical model value versus the lower bound. Again, the upper bound doesn't come into play. The unique insight for ABM, if you'll notice the time value in this case, it's symmetric on both sides. And so the time value peaks at the present value of the strike when the stock price equals the present value of the strike price, or right here. And so it peaks there. Both calls and puts are identical. But if you'll notice, there's a symmetry in this particular distribution, as opposed to being kicked out to your right or positively skewed, as is with the log normal distribution. Interestingly, a lot of financial data, the options market infers a negative skew in the implied distribution. Hence, a symmetric distribution, in my mind, is better than a positively skewed distribution. These are just some other things to note. Convergence, as the number of time steps go up, is very clean with plain vanilla options, a little bit noisy with digital options. When we introduce dividends, about the only effect is that the lower bound shifts to where the stock price equals the strike price. That's only because the risk-free rate and dividend yields were both assumed to be 5%. And we see here that the time value feature, again, has the same symmetry. And there's numerous other statistics that we could deploy. And if you'll notice, the convergence is much cleaner for vanilla options as opposed to digitals. With American style options, again, we have this convergence to the lower bound. And with both European and American style, the binomial model is seen to converge to the lower bound of European or American, depending on which of the boundaries are in play. And it's important, because this is a new model, to make sure that it doesn't violate these boundaries. With a non-dividend paying call option, early exercise has no value, and in fact, that's what we see within the ABM framework. With a put option, that's not true, and we again see that the put time value for European style is actually exceeds the American style, at least for lower stock prices. And again, there's multiple different diagrams that you could produce. If we look at the American style with dividends, when there is a dividend payment, then early exercise is a possibility with the call option. You can see this best in the time value plot. It's kind of hard to see here, the convergence to the appropriate lower bound. But in the time value, as you go deep in the money for a call, there are times when it's worth more to exercise it early, and hence eliminates the time value. And with the put, when it's deep in the money with a low stock price. And again, there's additional plots produced. If we turn to the quantitative material, just to introduce the thinking within the arithmetic Brownian motion, we're going to again introduce notation, focus on the 1 and 2 period models, introduce the coherence conditions, and then provide the results for multi-period models. And so the notation here is identical to the prior case of the geometric Brownian motion, so I'm not going to take the time to go over it. The difference here in the 1 period model, if you'll notice, if up occurs, the way we're going to model this is this U is the dollar increase in the stock price. And this D is the dollar increase if the down arc occurs. And so D could be negative, U could be positive, but the key is U is greater than D. And so with a single period call option, we're going to focus on creating the hedge portfolio, just like we did before. We'll derive the call value, look at a numerical example. And so the payoff at expiration is simply going to be the stock price plus U minus X, as opposed to the stock price times U minus X in the same sort of pattern if the down arc occurs. And so you have the up and down within the additive 1 period call option binomial framework. Again, we want to create a hedge portfolio, so we're going to go long 8 shares of stock and short 1 call. The goal is to have the terminal value of this portfolio have these two equal to each other, have these two cash flows equal to each other, and we can do that by solving for the optimal hedge ratio for the call. In the diagram basically illustrates once we have the complete tree for the stock, we can build the call tree. With the call tree and the stock tree, we can build the value of the portfolio. Solving for the optimal hedge ratio, we again get the cross-sectional change in the call versus the cross-sectional change in the stock. If you'll notice here that the results are independent of the level of the stock price. Again, the valuation model is very similar to GBM in that we have, we can see with the no arbitrage case that the call option is a leverage position in the stock. We buy a certain number of shares, we finance a certain amount. That's exactly equal to the present value of the expected terminal payouts, where the probability is found based on the equivalent martingale measure. And so there you can see a lot of similarities, but there are some differences. If we carry a numerical example, as we did before, you could calculate a variety of different results. Here the hedge ratio is 0.5331. Again, calibrating these up and downs to be consistent with the geometric Brownian motion case. And what we'll notice is that the no arbitrage model solution gets us 1138. The equivalent martingale measure solution gives us the exact same amount. And so the similar sort of pattern holds with ABM as it does with GBM. Single period put that is going to be structured in much the same way. So I'm going to quickly go through this. Again, if up occurs, the put value goes down. That's because S plus U is higher than S plus D. And so from that, we can build a hedged portfolio by buying 8 shares of stock and buying 1 put. With that, we can solve for the value of the up and down moves. Once we have those, we can set the hedge ratio such that the up and down value of this hedge portfolio is equal to each other. If we do that, we'll have the optimal hedge ratio. Again, is the change in the cross-sectional change in the put divided by the change in the stock. And again, the no arbitrage results involve some financing as well as a position in the stock, which is identical to the present value of the expected terminal payout. Again, running some calculations just to check to make sure you have the intuition. We get the hedge ratio of 0.4669. With that hedge ratio, we can compute the no arbitrage solution, which would be $10.42. And with the case of the equivalent martingale measure, it's also $10.42. And so 2 valuation models provide the exact same results. And so in the next part, we'll finish up with ABM binomial model.